In the last 10 years, one simple category of investment turned £10,000 into over £35,000, while millions of people sat in cash accounts earning less than inflation, quietly losing purchasing power every single year. The next 10 years won't look identical to the last 10. Nobody can promise that, but history gives us strong clues about which types of investments tend to reward patience. Today, I'm walking through the categories worth understanding and the mindset mistake at the end that quietly wrecks more portfolios than picking the wrong investment ever does. Quick honesty check before we start. Nobody can predict the future with certainty. Anyone promising guaranteed winners for the next decade is selling you something. What we can do is look at durable categories that have historically rewarded long-term investors and understand why they tend to work. This isn't personalized financial advice. Think of it as a framework to research further for your own situation. Let's get into the categories. Step-by-step solution. 1. Choose a low-cost global or total market index fund as a core holding. 2. Check the expense ratio. Aim under 0.2 to 0.3%. 3. Set up automatic monthly contributions. Common mistake. Assuming the sector that led the last decade will automatically lead the next one and overloading a portfolio into it. Category 2. Real assets, property and infrastructure. Problem: ignoring real, tangible assets in favor of only holding paper investments like stocks. Why it matters: real assets, property, infrastructure funds, REITs, often behave differently than stocks and can help diversify a portfolio. Real example: during periods of high inflation, real estate and infrastructure investments have historically held value better than cash sitting in a low-interest savings account. Step-by-step solution. 1. Consider a REIT fund if physical property isn't accessible. 2. Treat this as a smaller, diversifying slice. 3. Research specific fund holdings. Common mistake: going all in on property because everyone knows property always goes up. Real estate markets can and do stagnate or decline for extended periods. Category 3. Bonds and fixed income. Problem: ignoring bonds entirely because they seem boring compared to stocks. Why it matters: bonds tend to be less volatile than stocks and can help cushion a portfolio during stock market downturns. Real example: during the 2008 and 2020 stock market crashes, government bonds held their value far better than stocks, giving diversified investors a buffer. Step-by-step solution. 1. Allocate a portion to bonds. 2. Look at low-cost bond index funds. 3. Rebalance annually to keep your ratio aligned. Common mistake: holding 100% stocks regardless of age or timeline, then being forced to sell at a loss during a downturn because there's no cushion. Category 4. Investing in yourself, skills and income. Problem: focusing only on financial investments while ignoring your own earning ability. Why it matters: higher income means more money available to invest consistently, which, combined with time, is one of the biggest drivers of long-term wealth. Real example: someone who invests in a skill that increases income can compound that advantage every year, often outpacing market returns in the short term. Step-by-step solution. 1. Identify one income-increasing skill. 2. Treat learning cost as an investment. 3. Redirect income increases into your investment accounts. Common mistake: treating investing and career growth as separate topics when they're deeply connected, especially early on. Category 5. International diversification. Problem: keeping all investments concentrated in your home country's market. Why it matters: home bias can leave a portfolio exposed if that specific economy underperforms over the next decade. Real example: investors concentrated in a single country have gone through extended periods of poor returns while other regions performed well. Step-by-step solution. 1. Check your home country percentage. 2. Consider a globally diversified fund. 3. Avoid trying to guess which country will win. Common mistake: assuming your home market's past performance guarantees similar future performance, simply because it's what you're most familiar with. The biggest mistake of all: chasing the next big thing. Problem: constantly shifting your strategy to chase whatever asset class is trending right now. Why it matters: chasing hype instead of following a plan has historically cost investors more than almost any individual bad pick. Real example: investors who repeatedly jumped between trending assets often underperformed those who simply held a diversified, boring portfolio the entire time. Step-by-step solution. 1. Build a diversified base first. 2. Cap speculative bets at a small percentage. 3. Review your strategy annually, not per headline. Common mistake: treating each new trend as the exception that requires abandoning the whole strategy. Here's how I'd approach the next 10 years, step by step. 1. Build a diversified core. 2. Add real assets and bonds. 3. Invest in your own income potential. 4. Diversify internationally. 5. Ignore the hype cycle. Nobody can hand you a guaranteed list of winners for the next decade, but a diversified, consistent, patient approach has a far stronger track record than chasing predictions ever has. If this helped, subscribe for more real talk money breakdowns and tell me in the comments, which category are you most underweight in right now?